I'm David Coe of the Australian Financial Review. I write articles for the Financial Review at major turning points in the markets, and to do that I rely on David Hunt. They say no one rings a bell at market tops and bottoms. However, David is known as the bell ringer for the timing and accuracy of his calls. His record has been remarkable. Using a mix of fundamentals and sentiment indicators with market structure, he called the tops in the ASX 200, BHP Billiton, Fortescue Metals, and a swag of other stocks within days of their peaks in 2007 and 2008. He then correctly forecast the timing and levels of the index's intermediate peaks and troughs all the way down to its bottom in March 2009 and then up again for the rest of that year. As the market worked its way lower, bouncing between its intermediate highs and lows, the Financial Review was quoting him, Sky News was interviewing him, and his private clients were receiving daily email updates. On the day the market topped at 5025 in April 2010, he told me at the Financial Review the uptrend was exhausted. David said it was time to prepare for a bear market, and he correctly identified where it was headed. It's been a wild ride on the stock market over the past few years. The market soared to great heights by late 2007, and then went into free fall amid a global panic. Most investors have a buy and hold strategy, whether or not it is appropriate for the times. So much wealth wiped out in the fall from November 2007 that halved the value of the market. In a bull market, it is relatively easy to make a profit, even from buying rubbishy stocks. Many investors simply buy the dips and wait for the rise to come. When markets rise further, everyone gets more and more bullish. Investors, brokers, fund managers, advisors, the media, and public opinion all become increasingly bullish as the market pushes to new highs. The higher it goes, the more bullish everyone gets. That's when taxi drivers start giving you surefire stock tips. But as Warren Buffett says, don't confuse brains with a bull run. After all, a rising tide lifts all boats, even the unseaworthy ones incapable of surviving a storm. When everyone is bullish and no one thinks the market can go down, that's the time to start worrying. That's the time to bank your profits. This is where David's methods really pay off. They allow him to stand apart from the crowd. Warren Buffett also said, when the tide goes out, you see who's been swimming naked. That's because many investors are overgeared and have to sell their stocks at any price to meet margin calls. That drives the market lower. A lot of investors continue to buy the dips, only to see prices fall further. Many investors are wedded to their buy and hold strategy. They end up being long and wrong, so they sit tight, hoping the market will give them back their losses. As prices free fall, sentiment gets worse and worse until everyone who was bullish at the top gets bearish. When the pain becomes unbearable, the last finally sell and a bottom is formed. To quote Buffett again, when everyone is greedy, it's time to panic. When everyone is panicking, it's time to be greedy. At the end of February 2009, David told the Financial Review the market was bottoming. A week and a half later, the market started to rally. But many investors no longer had either the financial capital or the emotional capital to buy back into the market. They were sitting on the sidelines suffering. As share prices rose by half, they were wondering whether to get back in or whether to stay out. But David's private clients have been making money on both the long and short sides of the market each time it went up and each time it went down. Let's recap the rollercoaster ride that has been the ASX over the past couple of years and see what David said and when he said it. Remember, the market had been rising since 2003. It has been rising consistently, with every dip being a profitable buying opportunity, even the scary ones. In October 2007, David told the Financial Review, the fat lady is singing, the bull run is over. Within a couple of weeks, the market showed how exhausted it was and rolled over, and David's clients were positioned to make money in a falling market. By March 2008, the market was at lows not seen in 18 months, and investors were fearful. But David went on Sky TV and said, next month will be bullish. And it was. After a 1,000-point rally, and with investors hoping the worst was behind them, David warned, the tide is about to turn down again. And down it went, making losses since November 2007 to about 26%. Then David had more bad news for buy and hold investors. hang on for a drop to 41.64 and then another to 34.40. The first stop was 41.64. Then 34.40, just as David said. In January, as the media were finally telling investors about the advantages of preserving capital by buying bonds or even going to cash, David said, the perfect target for this market to bottom is at 3,200. That was just 6 weeks before the eventual bottom. A week and a half before the ASX 200 made its final low just under 3,200, David said, we're about to bottom before climbing to 4,200. And 4,200 is where it went. And that gave David a next target of 4,800, with downside targets after a top of 4,500, with 4,200 after that. What did the market do after it hit 4,800 in October 2009? The first thing it did was fall to 4,500, David's first downside target. And then it spent a couple of months gyrating sideways, testing the patience of mere mortals, first to the upside, then to the downside, and back to the upside. Six months after David's call, it was still range-bound and within 4% of his upside target. At this point, the bulls were getting excited at breaking into blue sky, and the Financial Review published a special supplement on the index breaking the 5,000-point barrier. But David wasn't sucked in by the euphoria. He alerted his clients to a worrying development that many market players had missed. A widening triangle had formed. As David told his clients, if the market fell from here, there was no support before the bottom of the triangle. More importantly, he went public and told the Financial Review that not only was the market pushing against its upper barrier, it was showing signs of exhaustion. On the day of the top, I spoke with David and he said, that was it. And the market started to fall, and kept falling to the bottom of the triangle. And then it went straight through the bottom of the triangle, straight to 4,200. It stopped at 41.75, 25 points below David's second downside target. So why is David so good at that his clients call him the bell ringer? What are his methods? Let's look at them. Underneath the apparent random moves of the stock market is a definite structure. There's an impulsive wave up and a corrective wave back that retraces part of the initial thrust. Each thrust and correction is made up of smaller thrusts and corrections, and also builds larger thrusts and corrections. The volume of sales is important in determining if a move is impulsive and likely to go higher, or corrective and likely to reverse. Telling them apart is the difference between chasing a move and getting a safe entry before the real move resumes. The more bullish investors get until everyone's on board. Then it falls. The lower it goes, the more fearful they get until the last seller has dumped their stock. Then the market rises. Extremes in sentiment identify market tops and bottoms. David is the Vice President of the Australian Professional Technical Analyst Association. He trains investors and traders in market strategies, in what to buy, what to sell, when to get in, when to get out. David is licensed through ASX to give advice. To learn more about trading, contact David through his website ads.com.au or by phone 1300 552 182.